In a surprising turn of events, oil prices have dipped, reaching a 2-week low, primarily due to an unexpected increase in U.S. crude stockpiles. This development has raised eyebrows as it coincides with the anticipation that OPEC Plus will deliberate on further increasing oil production targets during their upcoming meeting this weekend. On Thursday, Brent crude futures experienced a decline of 65 cents, or 1.0%, closing at $66.95 per barrel. Meanwhile, U.S. West Texas Intermediate crude saw a decrease of 49 cents, or 0.8%, settling at $63.48. This marks the lowest closing price for Brent since August 20th, indicating a notable shift in market dynamics. According to the U.S. Energy Information Administration, EIA, energy companies added 2.4 million barrels of crude to their storage facilities in the week ending August 29th. This increase comes as refineries prepare for their maintenance season, which typically leads to reduced production. Analysts had predicted a withdrawal of 2.0 million barrels, making this unexpected build a significant point of concern. Additionally, the American Petroleum Institute, API, had reported a smaller increase of 0.6 million barrels, further highlighting the surprising nature of the EIA's findings. John Kilduff, a partner at Again Capital, remarked, "This is a little bit of a bearish report with that crude build," emphasizing the potential negative implications for oil prices. It's worth noting that the EIA and API released their inventory data a day later than usual due to the U.S. Labor Day holiday, which may have contributed to the market's reaction. Looking ahead, OPEC Plus, which includes 8 members of the Organization of the Petroleum Exporting Countries and allies like Russia, is set to meet on Sunday to discuss the possibility of increasing production further. Sources familiar with the discussions have indicated that this could send a strong message prioritizing market share over price stability. Tomás Varga, a senior analyst at PVM Oil Associates, pointed out that such a move would signal a shift in focus for OPEC+. Since April, OPEC Plus has already agreed to raise output targets by approximately 2.2 million barrels per day, in addition to a 300,000 barrel per day quota increase specifically for the United Arab Emirates. In the broader economic landscape, recent U.S. macroeconomic data has shown some instability, with new applications for jobless benefits rising more than anticipated last week. This has fueled speculation that the Federal Reserve may consider cutting interest rates in their upcoming meeting. Investors are increasingly viewing a 0.25 percentage point cut as a likely outcome, given the current federal funds interest rate target range of 4.25% to 4.5%. Central banks, including the Federal Reserve, utilize interest rates as a tool to manage inflation. Lowering rates can reduce borrowing costs for consumers, potentially stimulating economic growth and increasing demand for oil. On a related note, discussions surrounding the independence of the Federal Reserve have gained traction, particularly following testimony from Stephen Miran, an economic advisor to former President Trump, during a Senate Banking Committee hearing. Lawmakers from both parties pressed him on the importance of maintaining political neutrality within the central bank. Across the Atlantic, Germany, Europe's largest economy, has seen leading economic institutes revise their growth forecasts for 2025 and 2026 downward. This adjustment is attributed to U.S. tariffs and delays in the anticipated boost from increased public spending, which is crucial for an economy heavily reliant on exports. In a separate but related matter, U.S. President Donald Trump urged European leaders to cease purchasing Russian oil, claiming that such transactions are financially supporting Moscow's military actions in Ukraine. A reduction in Russian crude exports could potentially lead to an increase in global oil prices, as Russia was the second largest crude producer in 2024, following the United States. In response to the changing market conditions, Russia's largest oil producer, Rosneft, has secured a new agreement to supply an additional 2.5 million metric tons of oil annually to China via Kazakhstan, as reported by Interfax news agency citing Russian Energy Minister Sergei Tsivilev. Meanwhile, in Venezuela, an OPEC member facing U.S. sanctions, oil exports surged to a 9-month high of 900,000 barrels per day last month. This increase follows the granting of a license to U.S. oil giant Chevron, allowing Venezuelan crude to re-enter the U.S. market. As we navigate these complex developments in the oil market, it raises important questions. How will OPEC Plus's decisions impact global oil prices? And what are your thoughts on the potential interest rate cuts by the Federal Reserve? We invite you to share your opinions and engage in the discussion.